Hi, everybody. My name is Brad Gatto. I'm a national speaker, trainer, and educator, as well as an owner here at Fiat Wealth Management. And I'm here today to give you some real quick education on taxes in retirement. The two largest expenses for retirees today are healthcare and taxes. And so today, we're going to focus on something very, very important, and that is your overall tax liability as it relates to the entirety of your retirement. Now, I want to start off with a quick story about mountain climbing, because at the end of the day, we love the analogy of peaks and valleys in life and this idea of climbing mountains. And we have a lot of them in life to climb, whether it's education and getting through school or college, or it's raising kids or your marriage, or whatever it may be for you. But one of the biggest mountains we have to climb is this idea or concept of retirement. I mean, if you think about it, you guys, we spend 30 or 40 years preparing for this day when we stop working. And when I think about the analogy of mountain climbing, the day you retire, you're right at the peak of the mountain and you did it. It's awesome. It should be should be celebrated. And I'm sure a lot of you, if you already retired, did celebrate that day because it's the culmination of an amazing journey. That said, you have to get back down the mountain, and descending the mountain and being in retirement is a whole different deal. In fact, we joke around all the time that it's a complete 180. And a lot of the things that you did to climb the mountain are the opposite of what you actually have to do to descend the mountain. You know, the tallest mountain in the world is Mount Everest. And it's 29,035 feet. And you guys, there are people that attempt to climb Mount Everest every year that just don't even make it. There's also people every year that try to climb Mount Everest that die during the trek because it is so dangerous. But what's crazy is for every one person that dies climbing that mountain, 4 people die descending that mountain. Now, there's a lot of reasons for that, you guys, but it's a perfect correlation to retirement. For all the mistakes you could possibly make climbing the mountain that is saving for retirement to the day where you actually get to retire and rejoice, there are far more pitfalls and mistakes you can make on the way down. And a lot of those pitfalls and mistakes relate to taxes. And so if you think about that day that you retire, and you're now tasked with this idea or concept of, I have this pile of money that I've saved for the last 30 to 40 years of my life. How in the world do I protect it and turn it into a paycheck, right? It's always the fear of, I don't know how to do this. I've never been a spender before. I've always been a saver, and now I got to take this pile of money and I got to turn it into a paycheck, and I got to protect it from the things that are trying to get at it. And that could be market driven and the economy and all those sorts of things. But another big piece of that is the IRS. You see, the problem is that the majority of the people that we have met over the years here at Fiat Wealth Management, and with all the speaking I've done on this topic and the thousands of people that I've interacted with, the biggest problem is that their pile of money looks like what you see on the screen. You see, there are 3 different types of money. We're going to talk more about this in a couple of minutes. There's 3 types of money as it relates to retirement. And the vast majority of people's money is saved in this bucket that is pre-tax. You guys, that's 401k money, that's IRA money, that's 403b, 457 plans. Any money that you put away on a pre-tax basis that you have not yet paid a tax bill on fits into that green part of the pie. Well, the problem with that is when you go to spend that money in retirement, you have to pay a tax bill. And just like when you were earning income in your earnings years and your savings years, anytime you earn income and you bring that income in the door, there's a tax impact to that. And so what we want to talk about today is this problem of the vast majority of my money is sitting in a pre-tax bucket. So how in the world do I get it out of there? Here at Fiat, we like to call this an IRA exit strategy. And so we want to begin the conversation of not just de-risking your retirement from an investment standpoint, but de-risking your retirement from a tax standpoint. And so you should see a little pop-up down in the bottom left-hand corner of your screen. If you click on that pop-up, what that's going to do for you today is get you into the calendar of a fiduciary advisor for a 20-minute consultation, where you can begin that conversation of, great information on this WebEx. I want personal feedback on my situation, and you can begin that conversation. We'll give you an opportunity for that later as well. And so as we jump in, we're going to talk about how do you protect your retirement? How do you protect your house from this thing that is taxes. As I said before, you guys, it's one of the two largest expenses that you're going to face. And so anything that you can do today can have an exponential impact on not just the value of your portfolio, but the overall just satisfaction you have in retirement and clarity around where your money's coming from. A couple of disclaimers before we jump in. I'm not an IRS agent, and I do not work for the Social Security Administration. I want to start with a case study. This is a real study, a real case that we ran across a couple of years ago. I was a married couple. They're both in their, one of them was in their upper 60s, one was in their 70s, and they have three different sources of income coming in the door. One of which was Social Security. You can see that there. They did have some long-term capital gains coming in the door, after tax investments kicking off gains. Could have been dividends, something to that effect. They also have $45,000 in RMDs, required minimum distributions. And if you're unfamiliar with what that is, if you have any money in IRAs, 401ks, and you are like most people out there where that's the vast majority of your retirement savings, the IRS is only going to allow you to defer that bill for so long. Once you reach the magical age of 72, they require you to start pulling that money out and paying that bill. Make a mental note of that, because if you don't have a plan for RMDs prior to the age of 72, you will end up with some sort of tax impact, negative tax impact in your situation. So that's what they've got going on. This screen here, guys, is going to show you the tax system in a visual sense. We call it a tax map. The yellow that you see on the screen is the actual tax code. And so it looks like a set of stairs. The marginal tax rates start at 10%. That's that first bump. Then they move to 12. That's that next little yellow bump. And then they go up to 22%. And so as you earn more money, you pay more and more taxes in our marginal code. The gray that you see there is this married couple's actual effective tax rate as they walked the code. And as you can see, they floated above the code for the vast majority of the time. And there was a season of their income in the middle of the year there where their effective tax rate was 49.95%. Now, you guys, at that point in time, they were in the 12% tax bracket. So why, if they're in the 12% tax bracket, is their effective rate 49.95%? Because what intuitively should happen is if you, at that point as a retiree, take $1,000 out of your IRA, and you're in the 12% bracket, you should just be paying 12% or $120. Well, what actually happened, you guys, is that $1,000 IRA withdrawal did in fact cause that $120 tax bill, that 12%. But it also caused two other tax impacts at the exact same time, almost like an avalanche effect on this descent down the mountain. The second thing it caused was more Social Security to become taxed. If you're unfamiliar, your Social Security payment that you get can be taxed. There are some people that get it tax-free. It all depends on this wonderful thing called provisional income. If you're unfamiliar, that's something that can be discussed in that mini consultation with that fiduciary advisor. Bottom line is this: that $1,000 IRA withdrawal took money that was in a tax-free Social Security bucket and moved it into the taxable Social Security bucket, causing another $102 to become billed. It also, those two things combined, caused some of their after-tax investments to become taxable. You see, after-tax investments have their own tax system set up, if you will, and the first bucket or bracket in the after-tax is 0%. And so money that was sitting in the 0% rate got moved into the 15% rate. I got to pay that bill too, $277.50. Those three bills combined add up to $499.50 for my $1,000 IRA distribution. So here's what's crazy, you guys. In retirement, it's not about how much money you live on that's going to determine your tax bill. It's where your income comes from. And for retirees, this could be more than 5 different places, more than 5 different sources that make up your retirement income paycheck. You could have a pension or two coming in the door. You could have Social Security checks coming in the door, IRA distributions, 401k distributions. You could have Roth IRA distributions, after-tax investment distributions or dividends coming in the door. And all of that's kind of flowing into your taxes. And without knowing where you're at and knowing the impact that that can have, you can end up just like this couple, where they think I should be paying 12%, when effectively they're paying almost 50. So what do? I'm going to give you a couple of concepts to take home with you to hopefully have a massive impact, not just today, right? Because these are concepts that exist into perpetuity as the tax law stands today. And so the first concept that I want to give you is what I call 3 types of money. And we're going to talk about another concept called to defer, or not defer. So 3 types of money. You guys, when it comes to taxes, there are only 3 types of money. There's pre-tax money, after-tax, taxable money. That's the middle bucket. And then after-tax, tax-free money, tax-free growth. That's the last bucket. Now, to give you some concept of the tax impact of these 3 buckets, let's go through a hypothetical scenario. On the left-hand side of your screen, you'll see ABC company stock. Now, you guys, if you and I decided together we're going to buy ABC company stock, ABC company stock can only do 2 things. It can go up in value and it can go down. Well, here's the impact from a tax standpoint. If we bought ABC company stock and it in fact went up in value, we hit a home run, and then we go to spend that money. If that money is in your 401k or IRA, the pre-tax bucket on the left, you're going to pay ordinary income tax on the entire thing, depending on what bracket you fall in. If it's in the middle bucket, it was after-tax money that we bought ABC company stock with. We bought it out of your checking account type of money. And then the growth of that stock, when we go to use it, we're going to pay capital gains rates on 0, 15, or 20%. If you're noting things at home, note this. Your capital gains rate is always less than your ordinary income tax rate. Okay, they coincide, but at the end of the day, your capital gains rate is always going to be less than your ordinary income tax rate. That's why I call capital gains rates preferred or preferential tax treatment. They're always less. Would you rather pay less or more when it comes to taxes? So there's a little bit of a break there. The last bucket, you put after-tax money in, ABC company stock goes up in value, we sell the stock. What do we owe in taxes? The answer is nothing. There's a tax-free growth bucket, okay? Here's the bad news. ABC company stock can also go down in value, right? And it doesn't matter where you buy it from a tax standpoint, you're going to lose money. But what's unique is that middle bucket, that after-tax taxable bucket, that NQINV stands for non-qualified investments. It's just my industry lingo. You can play some games down there. Tax loss harvesting. You can use some gains to offset losses, losses to offset gains, depending on what you're trying to get done. But you can actually you can write off your losses on your tax return and get some of that back in the form of a tax break. Now, that's a Band-Aid when maybe you need a tourniquet. But at the end of the day, it's the only bucket where you get any sort of reprieve for taking losses in your investments. And so quite frankly, if you're going to lose money, that's the bucket to do it in, okay? Lastly, we always get this question, well, Brad, what happens to my money at my death? What does it look like when it goes to my kids and grandkids? Well, it depends. Where do you own it? Do you own it in your pre-tax bucket? Because if you do, it's fully taxable to them at your death, and not at your rates and what your tax rates were when you were 85, 90 years old and you passed away, at their rates when they're 55 and 60 years old at a higher tax rate than you. The after-tax bucket is also unique in this scenario because if you own ABC company stock and you bought it at $100 a share and it's now worth $1,000 a share, if you sold that during your lifetime, you're going to pay taxes on the growth. If you pass it to your kids or grandkids, they get what's called a step up in basis. They get to act as if they bought it at today's stock price, and if they sold immediately, they'd have no tax bill. Roth IRA, tax-free growth to you during your lifetime. Also, tax-free growth to your kids. There will be no tax bill there either. Last thing here, and this is important. Pay attention to this part. One of the things my industry focuses on heavily is diversifying your portfolio from an investment standpoint. And so you've probably got money in all kinds of different stocks, mutual funds, ETFs. You've got it all over the board. And it stands to reason, you guys, that portfolio, that pie chart that you have, has positions in it that have more risk, and it has positions in it that have less risk. Has your advisor, or if you're doing it on your own, have you ever looked at it from a tax perspective of where you're taking your risk? And are you being as tax efficient as you possibly can as it relates to your investment risk? It seems to me that the IRS is incentivizing you as an investor to take your risk in your Roth IRAs and your after-tax buckets, and to not take as much risk in your traditional IRAs or 401ks, your pre-tax bucket. Why do I say that? Well, think about it. If I buy ABC company stock, why did I buy it? Well, I bought it because I think it's going to go up in value. Now, there's risk associated with that, but if I'm going to take that risk, I want to keep the reward, as much of it as I possibly can. Well, if I buy that in my 401k, my after-tax bucket, or my Roth, ABC company stocks still have the same amount of risk in all three buckets. The difference is if it goes up in value and it's in my IRA or 401k, I lose quite a bit of it to ordinary income tax. I don't get to keep all of my gains. If it's in my non-qualified bucket, I still have a tax bill, but it's less. It's preferential or preferred tax treatment. And if I buy that in my Roth IRA and it goes up in value, I get to keep 100% of it. All of that growth comes to me because it's tax-free. So auditing your portfolio from a risk perspective as it relates to taxes is vitally important. You should be taking the least amount of risk. Your least risky investments should be held in your IRA. Your most risky investments in your Roth IRA. Last thing, Brad, well, what do I do? Do I defer my money? Do I not defer my money? When we're talking about diversification from a tax standpoint, I'll just tell you right now that if your pie chart looks like the one that I just showed 5 minutes ago, where the vast majority of your money is in any one of those buckets, it's similar to having the vast majority of your money in one company stock. Of course, it poses a risk. So what do? Do I defer my money or do I start to take it out now? Because what you can do, if you were unfamiliar, is you can take IRA money and you can convert it to Roth money from the pre-tax bucket to the tax-free bucket. Now, on its way there, you have to pay the tax bill, right? And so in my scenario, the taxes are 25%. So if I had $100,000 in my IRA and I chose to convert the entire thing into the Roth, on the way over there, as I pay off the IRS, what I'm left with in my Roth is 75 grand. Is that a good decision or a bad decision? Well, let's just play it out. Let's say we defer both of those accounts for 10 years and they perform exactly the same. They're in the exact same investment portfolio. And so over that 10-year period, they both double in value. Well, now my IRA is worth 200 grand. Had I done the Roth, that would have been worth 150. And this is where everybody champions the cause of tax deferral, which is why you probably have the majority of your money in a pre-tax bucket. Plus, my industry probably told you your tax rates are going to be cheaper in retirement than they were in your working years. That's besides the point. In this scenario, if you look at it, there was a $25,000 difference initially. There's a $50,000 difference in the account values now. And everybody goes, see, this is why tax deferral is better. Because all of my money got to grow rather than only 75% of my money getting to grow because I paid off the taxes. But at the end of the day, guys, it's not about what you have. It's about what you can spend, right? Because I have to pay the taxes. And once I pay the taxes, what am I left with? How much of it do I get to keep? So let's just say the tax rate stays exactly the same. Okay, it was 25% 10 years ago. It's going to be 25% today. And so I'm going to take the taxes out of these accounts so that I can actually spend my money. Well, in the IRA, I got to pay 25%. That nets me $150,000 in my checking account that I can spend. My Roth IRA, I don't have a tax bill. That's tax-free growth. So I take that $0 bill out. I have $150,000 of spendable money. Notice something there? It's the exact same. So unless tax rates change and your tax rates change, the IRA and the Roth IRA are the exact same. It's just the IRA is betting on tax rates going down in the future. The Roth IRA is betting on tax rates going up in the future. Do you know where tax rates are going to go in the future? I'm sure you have an opinion. We all do. But none of us know for certain, except the fact that we have this Tax Cuts and Jobs Act that was enacted a couple of years ago that expires in 2025. We're living under a tax code right now as citizens in the United States that say that the vast majority of our taxes are on sale. There's 23 provisions put in place back in 2018 that expire in 2025. So I can say with a pretty high degree of certainty, your taxes are going to go up. But the bottom line is this. If you have the vast majority of your money in any one of those tax buckets, you should be looking at the idea or concept of diversifying your tax bill the same way your advisor or you have looked at diversifying your investment portfolio. I'll end by saying this. I hope you learned something in our quick time together today. This is part one or step one of a two-step process of you taking advantage of learning more for your situation about how to minimize the IRS's impact on your retirement. Part two is a 20-minute consultation with a fiduciary advisor. You can click on that banner ad down in the bottom left-hand corner to schedule that on your own, where we're going to answer questions like you see on your screen here. Where should my paycheck come from? Are my taxes on sale? And if so, what should I be doing about it? And can you review my existing investments to tell me if I'm structured in an efficient nature or not? Thanks so much for taking the time today. I hope this is going to be the most impactful 15 to 20 minutes you spend on your finances in 2021.